Welcome to the Angel Investors Network podcast. Greg Reiter is the CEO and founder of the Angel Investors Network, the first national angel group founded online in 1997, dedicated to perpetuating free enterprise, capitalism, and supporting the American dream. In addition, Angel Investors Network is the organization behind the powerful Mastermind Investment Club, dedicated to harnessing the philosophy of a mastermind to increase success with their investment portfolio. On today's podcast, Greg brings together successful high net worth investors to share with you how they invested successfully and achieved a profitable exit, and how you can too. And now, here's your host, Greg Reiter.
So Dennis, you and I have a little bit in common. So I'm 56. I also did my first investment when I was around 20 years old. My dad got me into a company called Denning's Mobile Robots. And my dad put 100 grand in. It was a pre-IPO. I put 7 grand in, and we sold out 4 times our money 4 months later. And you remind me of that guy in that sitcom, Michael J. Fox, when he was a kid on that sitcom, and he was the one crunching the numbers. He was the Wall Street guy, and real conservative in the household of liberals. It was a funny sitcom I remember growing up as a kid. So
yeah, family guy.
Let's talk about some of these angel investments you've done. I think you told me you've done about 12 angel investments, and you've had, how many exits have you had?
Well, my first acquisition was actually just recently. Nordstrom purchased one of my first angel investments, Bevy Up, which is like a Seattle-based e-commerce sharing platform. And so, we're all kind of like high-fiving, and it was a good result. I'm still a little bit early in my actual early stage angel investing career. I have to give it myself a little more time. So far, most of my investments are, doing very, very well. I'm cautiously optimistic, or, patiently optimistic that my strategies or my abilities to sort of disseminate, good investments from bad investments are sound. I'm learning a lot, however. So, I got a couple of obituaries, and, in those ones, you hope that you sort of sense that there's problems early, and so you don't follow on, and then you sort of limit your downside. That's what the case is with, early stage. It's incredibly volatile, and it's very risky. And I think a great early stage angel investor is aware of those risks. And I think the best ones are the ones that can, mitigate those risks and stay investing.
Yeah, no, absolutely. And I'm going to talk about that here in a few minutes, mitigating risk, because that's a big issue of what we deal with. And I want to get your input on that. But let me ask you this question, because you were talking a few minutes ago about how you went to work for a VC firm, and that's what kind of got you into this. And now you're on part of the Alliance of Angels. Tell me real quick, how you distinguish in your mind. I know I have my opinion on this, the difference between a VC firm and an angel group. And give the listeners a description of those two and what the differences are, in your opinion, from your perspective.
Yeah, sure. No problem. Well, I think that a VC is totally different than an individual angel. And for me, my last couple of years has been about understanding that difference and being able to be okay with that difference. A VC or a venture capitalist, when you're talking to an individual venture capitalist, it's important to understand what that person represents. That person, their check is in the millions of dollars, or it's capable of being in the millions of dollars. They the world occurs to them. They are an employee of a firm, and they have a salary, and they have to be at work at 9 o'clock in the morning, and they have to, stay at their desk all day and look at business plans and report to their other partners or their bosses. And then their bosses have to report to their LPs in order to generate returns for their LPs. and then so that they can raise more money from their LPs. And then their LPs are motivated by generating outsized returns, whether it be with this firm or with another firm or another firm. So there's a lot of stakeholders in that relationship. When a founder is talking to a VC, they are talking to dozens of stakeholders with opinions and authority and all those things. When a founder is talking to me, an individual angel, they're only talking to me. I don't answer to anybody. I don't check in at a certain time. I can blow off a meeting. I can dive deeply into a meeting. It's all me. It's a completely selfish game. I'm like a surfer. It's only me and the board and the waves. There's no one else. I'm not on a team. I don't, do anything like that. I don't get a salary in the traditional sense. I'm a completely iconoclastic individual. And so from that perspective, it's important to sort of understand that relationship. I mean, there's good things and bad things. When I write a check, I'm not writing a check for multiple millions of dollars. I'm writing a check for, $25,000 on the low end to maybe $100,000 on the high end. My entire, monetary relationship with the company is probably no more than me writing a check for $200,000 over the whole entire lifetime of the company. So, it's important to sort of understand that distinction in the relationship and understand like what that relationship represents for a company. So I don't offer a lot of dollars, but what I have to do is I have to be able to syndicate. It's probably a little bit easier for someone to create like a one-on-one relationship with me because all they have to do is get past me. With a VC firm, they have to get past the entire firm's sort of push. So it's a huge distinction. And I think that entrepreneurs are very well served to really understand that and to work within those frameworks because they are completely different animals.
Yeah, no, and I agree with everything you just said, and I'll add a little bit to that. So, the venture capital world, it's like, somebody was asking me the other day, where do venture capitals come from? I'm like, well, that comes from those guys that put $1 million and had a 300x return. Now they got $300 million, so they're a VC now. They're not an angel investor anymore, right? So, but the idea is the cycle's longer. The check's obviously bigger, but as you and I were talking before we started recording, it's also like a good old boys club. I noticed a lot of people in these VC firms, that they have those relationships within the firm on their last deal and their last exit, and they come for the next deal. So it is much more difficult. But if you have a great deal, you can get funded, but it takes longer, and it's more. It's just a longer sales cycle. Go ahead.
And I also think that the world that we are in is evolving very, very rapidly. And, I think VCs need to really kind of look over their shoulder because it's a broken industry. And, I have sort of a hot and cold relationship with VCs, especially the ones that I sort of deal with in Seattle. It's like they're good in some levels, but they're completely broken on other in other ways. So, for me as an investor, and you probably know this as well, is that when you see an opportunity to strike, that's a huge opportunity for investors. We look at those sort of inefficiencies in a marketplace. We look for those things that, frustrate us and bother us as opportunities for us to really take advantage of. And what I hope as an angel is to take advantage of the fact that, the VC industry in America is absurdly broken. I'm always looking for ways to just, bring it down and, balance the scales a little bit.
Well, it's funny you say that because I use the term vulture capitalist a lot because I've been vultured before. And I'm going, dude, I've been an investment banker for 20 years and I just got taken bad. And it's just like, and there's always a place for both venture capital and there's a need for it in certain situations. But I wrote one of the very first books on crowdfunding. So that I was just going to segue into this whole crowdsourcing and crowdfunding as a mechanism to raise, follow-on rounds and different rounds. And I really think it is a good solution personally for, B2C type customers. But let me get your quick take on crowdfunding and the new laws and the Reg CF for $1 million and under, and the Reg A plus and the 506Cs. What is your take on your personal take on the crowdfunding as an investor standpoint, as well as an entrepreneur?
I haven't really seen too many implementations where crowdfunding from an investor standpoint, sort of solves a lot of problems for a company. What I would just say is crowdfunding is exactly what sort of the name says. It's a herd mentality. And some entrepreneurs, or some founders, or some individuals in this marketplace are great at creating demand and establishing sort of like a herd mentality and herding the cats in. And a crowdfunding platform, really makes it easy for people to just click a few buttons and sign a couple of documents through, electronic signature, and the money is in the door. And I think that groups can be good at that. But I also think that there's some downside to that. For me, when I'm trying to create a relationship with a company, I'm looking to try to get directly involved with, the CEO or some of my contacts with the company, because I have questions and I have needs in order to really commit to something, because with my hard-earned money. So those are sort of like the positives and negatives. Now, crowdfunding in terms of like product fit, market fit, I think it is awesome. I've been a part of, 4 or 5 Kickstarter campaigns in products that I've been an investor in. And, I mean, this is going back to the early days of Kickstarter. They were monumental in helping us determine our product market fit. They basically guaranteed sales for, our sort of go-to-market. And they were the next wave of direct marketing. And if the CEOs and the founders that know how to market through a Kickstarter platform, if you're good at that, you're good. You're ready for, wide release. You're ready for a QVC spot. You're ready for a Shark Tank. You're ready for Facebook Live commercials and YouTube commercials. If the CEO it works the network on, Indiegogo or Kickstarter, you're good to go. So I look for a CEO or a founder that embraces crowdfunding as a way of doing it. And I think that you can be creative within those platforms, and you can use techniques such as upsells and guerrilla marketing and all those types of things in crowdfunding. So it's a great platform for the founder. I still need to kind of learn more about it from an investor standpoint.
Yeah, I've done a lot of both. And actually with one of my companies, we did a crowdsourced launch, so to speak. Last September, did $1 million in 1 week, but we didn't even use a platform. We built our own funnels, our own upsells, and our own stuff. And so we kept it all to ourselves. So it's very cool. So we got a few minutes left here. Let's talk about this risk mitigation. So from your perspective, I want to ask you on a scale of 1 to, I don't know how to ask this, but one of the things that I'm always promoting is Rolodex. You want to get investors to have a Rolodex. So you go back to the VC world or the angel world, and the one thing that VCs do bring, going back to like you said, they have the 12 limited partners, or whatever those LPs are. The Rolodex to help you succeed is pretty big. And then as an individual investor, you have the passive investors that don't really have a Rolodex, and guys like you sound like you get active and you're doing everything you can to help enhance. So talk about the benefit of Rolodex from your investors, and as an investor to help mitigate risks.
Yeah, well, I can't invest in a company, or I can't make a meaningful investment in the company without other people, just flat out. So, if I have a company that's raising $500,000, we're just hoping that their monthly burn is maybe at like $30,000 a month. I'm just throwing some, basic numbers out there. And that would give them like a 12 to 18 month runway in order to develop, what they're hoping to develop. and then, get to the next level. So in order to finish that syndication, I need to ask 4 or 5 other people, pass the hat and say, hey, listen, I like this idea. And, we think that you'd really benefit from that. So it's crucial. And what I say to entrepreneurs is you have to dig into the scene. You have to really become like a social person related to building this syndicate. You're going to get Dennis Joyce, and with Dennis Joyce, I could probably socialize it with 3 or 4 other people. And then, you would want to get it to the entire angel group that I represent. And if you can really master that process, you're ready to raise. And if you don't like that process, you're going to have a very, very difficult time making anything of this company. And I look for that when I'm an investor. If I'm asking questions of a founder and they're not enjoying the pitching process, that is my signal to get out of there. Yeah. Because if you don't like pitching it, if you are successful as an entrepreneur, if you are successful with this idea, you will be pitching this idea every day for the rest of the time you are running this business. You'll be pitching to your own team. You'll be pitching to bank people. You'll be pitching to other investors. You'll be pitching to Wall Street. You'll be pitching to investment bankers. You'll be pitching customers. You'll be pitching for the rest of your life. So the best founders are the ones that really embrace this. They make themselves vulnerable to the process, and they're willing to kind of lose themselves and lose their hangups in pursuit of the success of this concept. So
no, that's a great red flag. And that's another one of these questions I ask all the time is what is the red flags that you should look out for? And that's one of those red flags that you've got kind of ingrained in your subconscious that goes, when you get that answer, the bells go off. And I have a question I always ask, because I always ask entrepreneurs, well, I love your deal. Well, I haven't even told you my deal yet. I know, but I love it anyway. But I haven't even told it to you. I love your deal. Here's what I want you to do. Tell me what's wrong with your deal. Let's start there. And it always throws them for a loop. And you can tell the ones that if they can articulate to you what's wrong and how it can be fixed, okay, you got something. If they go, there's nothing wrong, So that's one of my ways for getting to the point really, really quick. I love that. It's awesome. So one last question now on this too. So for me, Rolodex, not only on the funding side, because that's where a lot of entrepreneurs, they get started and they don't raise enough money. That's probably one of the biggest reasons for failures, not enough money fast enough. But the other thing that we're working on with our Mastermind Investment Club is what we call the DVRS method of investing. We talk about deal flow. You got to have great deal flow to have great investment opportunities. And then Rolodex. And what we're trying to use is this mastermind principle to not only leverage the mastermind, the group for additional investors, but also who in the group, who in the club, who part of this club can open up a door to a retail distribution, to a manufacturer, to an attorney, to the best in class vendor that's going to help accelerate growth as well as mitigate risk, because we're giving those entrepreneurs trusted quality vendors or opening up doors that can get them in the door. And so Kevin Harrington and myself, we do a lot of that. So I'm assuming you're on the same page with that. But I do want to ask one last question, and that is structure. How important to you, this is one of the things we always talk to investors is structure. It's one thing to find a deal that you like. It's one thing, do I want to invest in this deal? And they have everything, all the ducks in a row. But then it comes to structure, how you structure the deal, and how do you think of yourself as an investor as far as coming up with a structure or a term sheet or coaching those entrepreneurs in that area, and how important is structure to you in your investment portfolio?
Well, to address one of the things that you said in your statement earlier, I would just say that it's important for an entrepreneur to ask for help. This is not just one person going out and taking on the world individually. We might be in a culture where, we think of ourselves as a hero and we're sort of us against the world. But actually, I'm looking for a founder that's engaging investors, employees, customers, all on this process and willing to ask for help. The thing related to structure of a deal and putting together a movement, we're looking to work together. an entrepreneur is not trying to sell me. They're just trying to engage me. I'm looking for an entrepreneur that's basically saying, let's do this together. Join me in this process. Not, hey, give me your money. It's join us in this movement. I'm listening for that when I'm talking to them. So when it comes down to like term sheet and structure and all these types of things, like I'm not designing a term sheet. I'm not even like killing myself to read every little sentence of a term sheet. I'm looking for an attorney in town, in my case, Seattle, that I am familiar with to structure the deal. And then I'm going to go to my attorney. And sometimes it's the same person. So I then have to go to my sort of second attorney and say, hey, listen, this is my term sheet from XYZ lawyer. I always use him. I know his terms. I'm familiar with his terms. How does this look? Is there anything here that I'm missing that's going to, kill me on the next round? But it's not an antagonistic relationship. We're working together to build this great company. I can't have any kind of sort of mistrust or funny games in the relationship. It all has to be completely transparent. It's hard enough to build a great company when you're working together, let alone when you're always trying to like cut corners and nitpick and like get one over on each other. That's no way to go. So in terms of like network and engagement, I'm thinking about how do we get like everybody on the same page, working our butts off to make this thing awesome. That's how I sort of operate.
No, that's great advice. And again, that goes back to every entrepreneur listening to this. You got to take this to heed because this is how investors think, right? And you might think a different way, and this is typical of how investors think. So, last question. So, I know that you're part of the Alliance of Angels and the Puget Sound Venture Club. Tell everybody listening, the prospective investors that I just sold my business, I got 20 million in the bank, or they've been a doctor for 30 years and they got millions of dollars and they want to play around this area. What is the benefits to belonging to a club, a group, and share your insights as the benefits of belonging to groups and clubs?
If you try to go alone, you will invest in for only about a year. You'll be done. You will take your hard-earned money. You'll take $25,000. You'll throw it at one of your first deals in like a restaurant that you want to, like a jazz club or, something that, interests you or occurs to you as important. And then you will invest it. That money will get completely squandered and you'll be, some blockchain token technology, something that you read about in Forbes magazine. You'll invest $100,000 and you'll realize that thing went, gonzo. And you'll just say, I don't want to do this anymore. This is the dumbest thing ever. I'm going to go back to investing with my broker at Merrill Lynch. That's what's going to happen. Yeah. If you want to actually do this as, a hobby or, an enrichment or a way to build your network, and you want to commit to 3 to 10 years of investing in companies, you need to have a plan, you need to have a discipline, and you need to do it intelligently. And the only way to really understand how to build a portfolio of early stage by yourself is to do it within a network. And so I advise everybody, go to the Angel Capital Association website if you want to become an angel investor, and find a group in your area where you're about 45 to 30 minutes away from a local group. Hopefully it's tied to, a vibrant economic place where you can, find good deal flow and go to the meetings, become part of the support group, dive in, add your value, because not only do you need sort of our experience, we need your perspective and experience to make this industry valid. We are all by ourselves, and then we have to work together. We are not a VC firm. I cannot sit down on a Tuesday meeting and ask 5 or 6 men and women, what do you think about this idea? We have all collectively looked at 1,000 business plans. What do you think of this idea? I don't have that ability. I'm only by myself. So when I see a great business plan, I have to do it within the angel network, within the Puget Sound Venture Club, in my case, or Alliance of Angels. And I have to go around the tables and say, hey, what do you think of this idea? What do you think about these guys? Oh, you like them? So do I. Let's all sort of put 25K into it each, and let's build this around and let's take it. Or, I might love an idea, and then 5 or 6 other people are like, well, the thing is, I have experience in this space, and this is the technology that we were working on 15 years ago, but there's no money in it. I don't individually have that perspective, but in Seattle, we have someone that might have worked on this in Microsoft in the 1990s,
right.
And now he's an angel investor, and he knows all the levers to pull, and he knows all the buyers and sellers and acquirers in this industry, and they can give us like a lot of perspective. And, I think that I would just say that do not go it alone. Join us in this, and let's really make this. And the companies need us. The companies need angel investors. VCs are so far away on the horizon for, your typical founder that needs to raise $1 million. A VC, at least in Seattle, they're not looking at you under $1 million. Because it's not going to move the needle at all. You need the angel investors, you need the angel groups to be as strong as you possibly can to syndicate amazing rounds for these companies to, take this thing to the next level. And I'm a big believer in that, and I couldn't say it enough.
No, so I sure appreciate you, Dennis. That's you're speaking my words. I mean, Angel Investors Network was birthed out of the mission to help perpetuate free enterprise and capitalism, and it's people that have the ability to write checks that get in there with the attitude of, sure, that we want to make a return on our investment, but we really want to help perpetuate free enterprise and capitalism. We want to be involved. We want to lend that mentorship. We want to help eliminate mistakes. We want to help with our Rolodex and expand and accelerate profits and, mitigate risks. So with that being said, Dennis Joyce, I appreciate you.
Wait, can I just add one more thing?
Sure.
Well, and I would also suggest any prospective angel investor to think of it from a portfolio perspective, really understand the percentages of a portfolio. If you are sitting on over $1 million, if you're an accredited investor, your basket of angel investments should be no more than 10% of your net worth. And I would also think that it could be more like 5%. And that is your alternative investment basket. And you should also be willing to live without that money that you're about to invest forever, because once you write that check, you don't have that $25,000 maybe ever again. So you need to be able to live without that money. And then and if you're expecting a return, that money is not coming back to you for at least 3 years, but more likely 5 to 10 years. Right. And you may never get that back again. So it's not about, writing a check in 2018 and I'm gonna be a trillionaire by 2021. You need to think about that as a very small portion of your investable assets. You got to say goodbye to that money, bye-bye, and then you have to work towards getting a good result afterwards. But it takes a long time, a lot of patience, and a lot of help, in order to do that. Sorry, I just needed to say that.
No, that's great advice. And I'll add one thing. You should probably plan on investing in about 10 deals, right? So if you're going to just invest in one, don't do it, right? Keep your money in your pocket, because your chances of having a return on one deal are pretty slim. And, if you get up to where you're going to make 10 investments, now you have a chance of 2 or 3 of those, providing some type of return. That would be
well, speaking to other investors will help guide those principles. That's why the network effect is really important.
Well, and that's what Angel Investors Network is all about in our Mastermind Investment Club. And the one thing for your benefit to know a little bit about us, we're a little bit different in that the Angel Investors Network is a nationwide angel group. We do webinars on a monthly basis, and we kind of collectively share information and news and tools to a membership site. And we kind of do what a local angel group does on a nationwide basis. and it's kind of an interesting philosophy that we're trying to, perfect and continue to grow. So, but I do got to wrap it up. I sure appreciate it, Dennis. If there's anything we can do to help you, or you got some deals you want to send our way, let us know, and we can possibly introduce them to our network of investors as well.
Yeah, we'll promote the hell out of this and heck out of this, and get my name out there. I like to read about myself on the internet, so throw me out there. I don't care.
Okay, man. You have a great day, Dennis. I appreciate it.
All right, Greg. Take care. Bye-bye.
Bye-bye.
This show has been produced by Market Domination, LLC. To discover how you can have your own show completely done for you and turn it into a real published book and become the authority in your marketplace, go to www.marketdominationllc.com/podcast offer.